You're listening to Seattle Real Estate Podcast.
Welcome back, you guys. A lot of people have asked me, hey, let's start covering the capital gains tax situation. Got a bunch of different scenarios where capital gains comes into play, both on the national level, state levels. Washington State's talking about capital gains, how it's not an income tax. It is. Let's be honest. Come on now. And so we're going to start talking about capital gains tax because that's what you guys want to talk about. All right? Let's do it. All right. GameStop highlights the folly of taxing unrealized capital gains. So capital gains that aren't really capital gains because they're unrealized. How's that look under the GameStop scenario we just had where it went from $4 to $1 million back down to $100? I mean, that was basically the run, right? So if we had unrealized capital gains somewhere in there, what would that look like? That's what we're going to jump into today here. If you're new here, my name is Sean Reynolds. I own a couple of real estate companies, but I read the news that you want to hear. All right. Less chit chat. Let's get into it. Less babble by the host. Start talking about something that makes sense. Here we go. As the GameStop roller coaster ride trundles ever onwards. Trundles. It's just trying to move forward. Trundles ever forward. Most are focused on the impact on retail investors, real people, and the hedge funds involved. But they are the villains, right? I mean, hedge funds. Those guys getting crushed. Everybody goes, yay! But this episode also illustrates what a mess a so-called mark-to-market system for taxing unrealized capital gains, as some Democrats have proposed, would be. Those rascally Democrats trying to tax unrealized capital gains just to get some more money in their system, right? Isn't that what we all think? Yeah. Hey, this would be a good, let's tax some stuff that shouldn't even really be taxed yet. Because we're calling it an unrealized capital gain tax, we might get away with this. Geez, could you imagine? Let's tax everything at its high point, right? Never mind that you have to sell something for it to essentially be taxed. But on capital gains, let's just tax it at its absolute zenith and see how this works out. We're going to rake in so many tax dollars. Whew, it's going to be good. No. So proposals for mark-to-market taxation of unrealized capital gains have been floated at both the state and federal levels by New York State Senator Jessica Ramos and Senator Ron Wyden, respectively, or disrespectively, however you see fit. The proposals are not identical, but they share the same common purpose of taxing capital gains on an annual basis, even when assets have not been realized or, in layman's terms, sold. Because that's really the only time you get a capital gain, right? Because you don't have a gain otherwise. Well, it's like everybody who sits around and talks about, man, I made $1,000 in the stock market. Did you sell your position? Oh no, I've still got it. I mean, why would I sell it? Because it might drop and then you will have made nothing. Oh, yeah. Well, I'm greedy. Therefore, I'm just going to keep my position. I mean, that's reality, right? I mean, that's oversimplifying all of this so hard, but that's the reality. So when you're talking about realized gains that haven't been sold, it's just crazy talk. It's just nonsense. But, some people are like, well, where can we get some additional tax funds from? All right, let's tax unrealized capital gain. I mean, crazy. Such a tax would be the first of its kind, as currently capital gains are only taxable upon realization. That is kind of a basic economics, right? I mean, because otherwise you're taxing stuff on situations that, you can't even really identify what the capital gain would be because it hasn't happened. You haven't had a gain. You could have a loss. Who knows? Because until you sell, those numbers don't really mean anything, right? One of the main issues with taxing unrealized capital gains is that they are just that, unrealized. When assets appreciate in value, the owner of the asset sees their net worth increase. But until the asset is sold, kind of like I just rambled on about to you, right? When the asset is sold, the value is essentially theoretical. GameStop stock has provided a stark reminder of how quickly that value can disappear. And one of the reasons I wanted to do this podcast is because you guys have asked for, hey, let's start talking about capital gains. And I know for a lot of folks, and maybe especially you younger folks, if you hear me say capital gains tax one more time, you're probably going to unsubscribe me and say, what are you talking about? We want to hear about the riots in Portland. And I understand that. But my demographic is also a little bit older. And so issues like capital gains tax are very important because it impacts people's net worth and how they are going to look at positioning their financial wealth, their financial being, maybe to their heirs down the road. Those are things that a lot of the audience here at the Seattle Real Estate Podcast are looking at. Those are very real issues, and I'm going to start covering them more. So thank you to everybody who's pointed out, hey, what about capital gains? It's like, all right, let's start talking about it. I mean, we might as well talk about it. It's important. Everybody's asking. Around this time last year, GameStop stock was worth about $4 a share. At its peak on January 28th, GameStop was worth over, not $1 million like I said, but they're worth over just $469 a share. Can you believe that for GameStop? A company that is a zombie. They are like Blockbuster, which has one store left in Oregon. They have one store left in Oregon, Bend, Oregon. I need to go see that store. How cool would that be? That would take me back to when my kids were infants and very little, and we went to Blockbuster a lot because when you have infants and your little kids, you don't leave the house a lot because it's a nightmare to take all that stuff, push them in a stroller, have the kids scream at the restaurant. You know that drill. But I am really looking forward to grandkids, though. I am. I mean, that'll be a fun event because then you can take said screaming child and hand it off to their parents and walk away. Goodbye, Grandpa loves you. That sort of thing. But the whole parental thing, we watched a lot of not at GameStop. We watched a lot of Blockbuster back in the day because that's what you did. You rented movies, and when the kids finally go to sleep, it's like, oh my gosh, let's just watch a movie. All right. So you did. Blockbuster. Didn't have all this streaming stuff like they have now. What was it? YouTube presented a major feature. They funded a major feature the other day, and it's like everybody's got a TV, they've got live streaming, and they've got content you can download. It's like all this major media stuff. As of Wednesday, GameStop is now hovering around $100 a share. So $4 to start, $469 peak, and then back down to $100 a share. Consider how the tax treatment of this fluctuation would work, particularly if GameStop's explosive growth had peaked just 1 month earlier than it did. In this case, the hypothetical owner of GameStop shares would face mark-to-market capital gains assessments on the massive growth shares of GameStop that GameStop saw between $4 and $469, even though they never sold and never made any actual cash. How much money did you make? I made $1,000. Did you sell? No. Well, you didn't make anything. You just held your position. On the other hand, when GameStop proceeded to fall back to earth, the taxpayer in the prior example would be left holding the bag, having paid taxes on huge on-paper gains in 2020, and then watching most of those gains disappear to kick off 2021. Disappointing. How'd you do? I did great in 2020, not so good 2021. But if you didn't see the drop in GameStop stock happening, I think you are a newbie investor. Because I looked at that and went, one of my kids was playing that market, and I went and he made a bunch of money, and I was like, all right, now you need to sell your position. You need to have some gains and move that into something that is more along the lines of a real investment. Nah, Dad, you're old. You don't know what you're doing. You don't know what you're talking about. I'm just going to play the market. And he did, and I can't remember what happened, but he'll be fine. He knows what he's doing until he doesn't, right? Furthermore, a retail investor who bought in early may not possess the cash on hand to pay a substantial tax bill under a mark-to-market system. The administrative difficulties of such a system are immense. Huge. I mean, so where are you expecting these people to get the cash to pay these taxes if you've got basically an unrealized gain and you're taxing them on the difference between $4 and $469. That presents some issues, doesn't it? And I am glossing over most all of this stuff. We'll get into this stuff deeper as we continually take a look at capital gains. But I mean, it's a pretty in-depth topic with a ton of different angles to it. Ask any CPA or tax accountant. Capital gains. So what do you think about capital gains? I mean, they've got stories and stories and stories of different angles and different ways that things should go. But, capital gains is something that's kind of in play right now, and a lot of people are talking about it. Washington State's talking about it. Our governor's talking about it. We should just throw in some capital gains. It's not an income tax, but it's capital gain. Whatever. Taxes is taxes, right? Small cap stocks have been on the upswing since March, but not all small caps are created equal. For the long term, small caps that have grown their dividends consistently may be a more attractive investment opportunity. Advocates of such a system have attempted to solve these problems. Senator Wyden's proposal includes references to deductions for capital losses, though the particulars are not spelled out. And as the Tax Foundation's Jared Walczak rightly points out, New York limits tax losses to $3,000 a year. Recouping the value of capital losses under this proposal could take years, even decades. So if you pay taxes on the difference between which you bought in at, $469 on the high end, you paid those taxes and then the value drops. Oh yeah, but you can get $3,000 worth of those losses back a year. You got to be alive a long time to have that make sense, right? Even if you didn't have that many shares. Because what you would have paid taxes on, hefty. Solutions to the problem of paper-rich but cash-poor investors are equally inelegant, meaning, we don't really know what this would look like, so why are we even proposing this? Wyden suggests a look-back period where investors can delay payment of their accrued tax bill for unrealized capital gains until they sell it. All right? A National Taxpayers Union Foundation analysis previously described why this is not a silver bullet. However, not only does a look-back period often entail added charges, but it essentially solves the problems a mark-to-market system creates by reverting to a more traditional system of taxing capital gains at realization, which is how it should be. You only have a gain if you sell. That's bottom line, right? All this other stuff, you're just trying to get greedy and, they're going to make some money, so let's tax them on their unrealized capital gains. Of course, none of this is to say that small-time buyers of GameStop would necessarily face capital gains taxes under the mark-to-market systems proposed by Wyden or Ramos. The intent of such systems is to tax the assets of the wealthiest Americans and include fairly high thresholds before their provisions come into effect. Here in the state of Washington, the wealth tax, was that state of Washington? Yeah, it was state of Washington, not Seattle. Get those mixed up sometimes. But we're going to tax everything over $1 billion, asset tax of 1%, I believe. And people are like, well, those people have the money to afford that tax. But the question is, maybe they do, but should they? And that, to me, that's the real question of, this is what you get for working hard and making a series of great business decisions. You get taxed heavily. How does that work? Well, that's kind of what we're looking at doing, right? I mean, that is what we're talking about. Nevertheless, the situation illustrates well the administrative issues inherent in a mark-to-market system, issues which have prevented the idea from taking hold in the past, because it just doesn't work. Congress and the New York State Legislature would do well to leave mark-to-market regimes on the drawing board where they belong, not in the tax code. Couldn't agree more. So this kind of gives us a little indication of, all right, so this is a unrealized capital gains issue. I mean, if the whole mark-to-market thing came about, if that became reality in some weird, odd world, these are some of the issues you'd have. It's a nightmare. It's a total nightmare. Never mind the fact these are not capital gains until they are. right? I mean, they're just not. They're not capital gains. So we're looking at taxing something that we're just looking at taxing something for the sake of generating tax revenue. Let's see, what's the angle here? How can we tax these gains even though they're not legit gains yet? Well, we're going to call it this. And let's just float it out there and see what people say. And of course, people are going to say no. But then there's going to be people who are going to say, well, I'm not wealthy. I'm not a billionaire, like the billionaire tax here in the state of Washington. Well, it only affects like 11 people, so why not? And where does that stop? Where does that stop? Let's tax unrealized capital gains. Where does that stop? That's the question I want to know. So you start taxing stuff that isn't necessarily taxable, and yet you make it taxable somehow. Where does that end? Does it end just there? All right, we got enough money. We got enough money to cover our bills because we've enacted this. No. It doesn't stop there, does it? It just keeps going and going. And soon enough, you get taxed on everything, kind of like California. Hey, let's give our citizens the opportunity to share in bill paying with the whole state by taxing them on their income, state income tax that Seattle does not have, that Washington does not have. Just don't have it. We're one of the few states that do. But with our budget shortfalls, the way that they are, with shutting down the economy, it's one of the issues, I think, right at the beginning of the coronavirus. A lot of people in the state of Washington are talking about look for a state income tax to come and not too far distant down the future, right? Because we gotta pay some bills, and you got to tax the people to pay bills. I mean, you can't run within your budget. I mean, that is not an option at the state level here or any state. Just you gotta tax people, get that income coming in, and then we go from there. Because then everything's gonna be rosy. It's gonna be fine. All right, that's it for me on this one. This is a kind of a super brief overview glossation, if that's a word. The whole GameStop, but I thought it was interesting because the whole GameStop really points out some stuff with the mark-to-market that it's like, yeah, that doesn't make any sense at all. There's a bunch of factors in there that this doesn't really work that way. And yet the whole mark-to-market, whole taxation issue seems to be on the table, and people are like, yeah, we don't really understand this, but we should do it anyway. We should do it anyway because there'll be more taxes to pay for stuff because we can't manage our money well. All right, that's it for me on this one. I am out of here. I hope you guys are doing well. Hope you're staying safe. I'll catch up with you guys on the next one. Until then, bye for now. Don't forget to subscribe to our channel and hit the notification bell so you'll know when our next video is out.